Welcome to the Deep Dive. We're here to cut through the noise, synthesize the data financials, research charts, everything, and give you the key insights you need.
That's the goal. We sift through it all so you don't have to.
And today, we are tackling a big one, Supermicro Computer, SMCI. You know, the company that basically became synonymous with the AI boom, the picks and shovels provider everyone was talking about.
Absolutely an incredible story.
So our mission today is pretty critical. Is SMCI built for the long haul, sustainable dominance? Or is this just a super high stakes gamble right now, maybe too volatile?
And the short answer really is that the market just cannot decide. It's profoundly divided. We've gone through, 7 comprehensive chapters of analysis here.
4 chapters, okay.
Yeah, covering the business, management, the financials, market vibes, who owns it, the risks, everything. And here's the hook. The share price, $44.90 as of September 28th, 2025. It's sitting almost dead center in our intrinsic value range, which spans from about $35 all the way up to $65 per share.
Wow. Okay, so a $30 range on a roughly $45 stock.
Yeah.
That's not just disagreement.
No, it's the definition of a battleground stock. Perfect paralysis, like you said.
So let's unpack that division. What's driving these completely opposing views?
Right. So we'll look at their business model, which is quite specialized. Then there's the management track record, some real red flags there historically.
Okay.
The financials are alarming in places, despite the growth. Then market sentiment, ownership, big external risks. We'll cover it all. But first, we need to understand the core business, their edge.
Okay, let's get into it. Chapter 1, Understanding the Machine, a business analysis.
All right. So Supermicro's core business is high-performance servers and storage. They pitch it as a total IT solutions model, meaning they aren't just selling boxes, they're designing systems, especially for the really demanding stuff like AI infrastructure. And the scale is huge now. Fiscal year 2025, they hit almost $22 billion in revenue.
$21.97 billion, yeah. Mostly from servers and storage.
The vast majority, yeah. $21.31 billion from that segment.
But how do they compete? I mean, you've got giants like Dell, HPE. They have over 16% market share each. SMCI is tiny in comparison, like 3.2% globally.
Right, that's the key question. It boils down to, 2 things mainly. Engineering speed and specialization.
Okay.
Their secret sauce is this proprietary architecture, server building block solutions. It's a modular design.
Modular meaning like Lego for servers.
Kind of, yeah. It lets them customize systems really quickly for the big clients, cloud providers, data centers who need very specific configurations. And they can do it faster than the big guys.
So that speed, the time of market, that's the real edge.
That's the crown jewel, absolutely. They work super closely with chip makers like NVIDIA. So when a new chip drops, say Blackwell, SMCI can get optimized systems out the door weeks, maybe even months, faster than rivals.
And in AI, where things change constantly, that lead time is everything.
It's gold, pure gold. Every day counts in that race.
But is that sustainable? I mean, is it just a temporary engineering lead, or is there something fundamental about their process that Dell or HPE just can't replicate easily?
That's the $1 million or maybe $1 billion question. It might be temporary unless you pair it with their other big focus, green computing.
The efficiency angle.
Exactly. AI chips run incredibly hot. Supermicro has serious expertise in direct liquid cooling, or DLC. This isn't just nice to have, it's becoming critical for these massive AI data centers.
Right,
because it slashes the total cost of ownership TCO potentially by up to 40%. Lower power bills, less cooling infrastructure needed. It's a specialized skill the giants are now scrambling to match at scale.
Okay, so speed, specialized cooling. Well, you mentioned the giants.
Yeah, the AI server market used to be SMCI's niche. Now it's the main event, the main battlefield. Dell, HPE, they're wide awake and pouring resources into competing directly.
So the pressure is mounting.
Immensely. And there's another constraint, too, a big one. U.S. export controls. The ER regulations limit selling advanced chips and systems to certain countries. That directly caps SMCI's potential market size.
Okay, so a tough competitive landscape getting tougher. That makes leadership even more critical. Let's pivot to that. Chapter 2, Evaluating the Architects. Management and capital allocation.
Right. So it's founder-led. Charles Liang started the company way back in '93. He's widely seen as a technical visionary. That's definitely a plus long-term vision, deep tech understanding.
There's always a but, isn't there? The history isn't spotless. We have to talk governance.
We absolutely have to. There was a major accounting scandal between fiscal 2015 and 2017. It involved improper revenue recognition booking sales too early.
That sounds bad.
It was. It led to multi-year delays in filing financial reports. They had to restate their financials eventually, and they even got temporarily delisted from NASDAQ.
Delisted, wow. And the CEO.
Charles Liang, yeah. The SEC actually ordered him to personally reimburse the company for profits he made selling stock during that problematic period.
Okay, wait. The CEO had to personally pay back stock profits because of an accounting scandal. That's a huge red flag.
Yeah.
Given their current massive growth, how can you be entirely sure the numbers are squeaky clean now?
Oh, that's exactly the risk premium the market is wrestling with. It hangs over the company, no question. It affects trust. Now, switching gears to how they use their money.
Capital allocation.
Yeah. Their strategy is simple. Growth, growth, growth. It's all organic. Heavy spending on R&D, aggressively expanding manufacturing new plants in Malaysia, California.
So no dividends for shareholders, no stock buybacks.
None. Zero. They retain 100% of earnings and plow it back into the business. They're betting everything on capturing this AI wave.
It's an aggressive bet. Is it paying off efficiently, though? Are they getting good returns on all that investment?
Well, that's where it gets concerning again. We look at a key metric. Return on invested capital, ROIC. It tells you how well a company is generating profit from the money it invests.
And for SMCI?
It peaked in fiscal 2023 at a really impressive 31.6%. But by fiscal 2025, it had plummeted to just 11.7%.
Whoa, from over 30 down to under 12. That's a massive drop.
It's a huge decline in efficiency. It strongly suggests that all this new capital they're deploying, building factories, scaling up operations, it's just not generating the same level of returns as before.
So they're spending more to get less, relatively speaking.
That's what the ROIC trend indicates. It really challenges the narrative of purely efficient, high-profit growth. It looks more like high-cost growth right now.
Which leads us straight into the numbers themselves. Let's break down the financials. Chapter 3, Financial Analysis.
Okay, first, the growth. As we said, it's explosive. The 5-year average annual growth rate is 45.76%. Just phenomenal top-line expansion driven by AI demand.
Incredible growth.
Yeah.
But you hinted at problems. Profitability.
Yes, that's the key weakness. And honestly, it's quite alarming. The margins are getting squeezed hard.
How hard?
Gross margin for fiscal 2025 came in at only 11.2%. That's down significantly from 13.8% the year before.
Okay, lower gross margin isn't great, but maybe costs elsewhere improved.
Unfortunately, no. Here's the critical detail. Despite revenue jumping 46.6% in fiscal 2025, their net income actually fell by 9% year over year. It landed at $1.05 billion.
Wait, revenue up almost 50%, but profit down 9%.
Exactly. That breaks a multi-year trend of rising profits alongside rising revenue. It's concrete proof that profitability is under severe pressure. They're not converting that extra revenue into bottom-line profit effectively anymore.
Why? What's causing that squeeze? It sounds like they're running faster just to stay in the same place, profit-wise.
It's a perfect storm, really. On one side, you have increased competition from Dell and HPE forcing prices down. On the other, you have rising costs. A big external factor we need to highlight is the U.S. tariffs of 2025. These impose duties on components they import, mainly from Asia. This directly inflates their cost of goods sold.
Ah, so tariffs are hitting their input costs directly?
Precisely. They're caught in a vice, costs going up internally because of tariffs and supply chain pressures, while prices are being pushed down externally by competitors. It's brutal for margins.
So, given this margin pressure, how is the market valuing the stock? What do the PE ratios tell us?
Well, the trailing PE is around 27.3. That's higher than their historical average, but way off the highs seen during the peak AI frenzy.
But the forward PE?
That's much lower, around 17.76. This huge gap tells you the market is definitely expecting earnings to grow substantially from here. They're betting SMCI can either stabilize those margins or just grow revenue so fast it overcomes the lower profitability rate.
A big bet. What about financial health, like debt?
Liquidity looks great short term. The current ratio is super high at 5.25. But leverage is creeping up. The debt-to-equity ratio is now 1.22. They are taking on more debt to fund that expansion.
Okay, a mixed bag financially. Growth is amazing, margins are worrying, valuation implies future recovery. Let's see how the broader market is digesting all this. Time for Chapter 4, Market Sentiment.
And, just like our value range suggested, Wall Street is completely split. The official analyst consensus might be buy, but dig deeper.
Yeah.
And you find 36% of analysts rated a hold, and another 12% actually say sell. That's almost half the analysts not recommending a buy.
That's significant disagreement. What about price targets?
All over the place. The range is just massive. The low target is down at $15.15, while the high target is way up at $63.
$15 to $63.
Yeah.
That confirms the deep uncertainty we talked about.
Absolutely. And maybe the clearest sign of bearish sentiment is the short interest.
Right, the bets against the stock, how high is it?
It is staggeringly high. 18.52% of the float is sold short. That's over 94 million shares.
Wow, nearly a fifth of the available shares are shorted.
It confirms SMCI is a true battleground stock. A huge chunk of sophisticated money is betting the price will fall. Of course, that also sets up the potential for a massive short squeeze if good news hits. Extreme volatility is baked in.
What are the technical chart signals showing?
Kind of reflecting that same indecision. The stock price is currently trading below its 50-day moving average, which sits around $47.25. That suggests short-term weakness or consolidation. But it's still above its 200-day moving average, which is around $40.91. That indicates the longer-term uptrend, for now at least, is still intact.
So technically stuck in neutral, waiting for a catalyst.
Exactly. Waiting for news, probably on margins or competition, to break the deadlock.
All right, let's look inside the company. Who owns it and what are they doing? Chapter 5. Ownership structure.
Okay, the big institutions are heavily involved. About 66% of the company is owned by large funds.
Like who?
The usual suspects. Vanguard, BlackRock, State Street. Together, they hold over 21%. So these long-term players provide some stability.
What about the insiders? The management, the founder.
Yeah.
People who really know what's going on.
They still hold a significant chunk, about 14%, mostly the Liang family. That should signal alignment with shareholders, right? High insider ownership is usually good.
Should, yes. But is it? What are they doing with their shares?
And here's the major contradiction, the really critical point for listeners. Despite that high ownership, the pattern over the last 12 months has been heavy, consistent insider selling.
Selling how much?
Over 3.8 million shares sold by insiders. And crucially, 0 open market purchases by insiders during that same period.
Wait a minute. 0 buys, but millions of shares sold. By the founder and executives who built the company and understand its tech edge, like the cooling systems?
Precisely.
If they are consistently cashing out at these prices, why should an outside investor feel confident buying in?
Yeah.
That seems like the ultimate vote of no confidence from the people who know best.
It is the single biggest tension point in the whole investment case, I think. It strongly suggests that insiders, while perhaps bullish on the long-term vision, believe the current stock price already reflects, or maybe even over-reflects, the future prospects relative to the very real risks.
Which is the perfect lead-in to our next section. Let's tie together all the potential downsides. Chapter 6, Risk Assessment.
Okay, let's summarize the key risks. Internally, the big worries are those declining profit margins we hammered on, relying too heavily on just a few key suppliers, that's supplier concentration risk, and of course the shadow of those past governance issues, that accounting scandal history.
Right, the internal weaknesses, but the external threats seem even more immediate, almost like a vice tightening.
I think that's fair. The single biggest external threat, without doubt, is the intensifying competition. Dell and HPE aren't niche players. They are giants with massive scale, huge enterprise relationships, and they are now targeting the AI server market aggressively. That directly threatens SMCI's pricing power and market share.
And macro factors.
Yeah, rising interest rates are a general headwind for growth stocks. It increases their cost of borrowing for expansion, and it also hurts the valuation because future earnings get discounted back at a higher rate.
And we already touched on the geopolitical risk with tariffs.
Exactly. Those U.S. tariffs of 2025 are not some abstract threat. They are actively impacting the company now by increasing component costs and directly contributing to that margin compression we discussed.
So fighting giants while costs are being artificially pushed up, a tough spot.
A very tough spot.
Okay, let's bring it all together. Final chapter, Chapter 7, Conclusion.
All right, so synthesizing everything. The bull case for Supermicro rests squarely on its specialization and speed. It's a pure play on AI infrastructure. It has real defensible advantages in time to market thanks to its modular design and partner relationships.
And the green computing angle.
And that crucial expertise in direct liquid cooling, which is becoming more important, not less. The massive revenue growth proves there's huge demand for what they offer.
Okay, that's the bull case. Clear. Now, the bear case.
The bear case focuses on the profitability crisis. Severe margin compression shows they can't easily convert growth to profit right now. There are serious questions about whether their tech moat speed and cooling is truly sustainable against giants like Dell and HPE, who are now fully engaged.
And the risks.
And the significant execution risk highlighted by the falling ROIC, the governance risk from the past scandal, and maybe most importantly, that bright red flag of heavy insider selling.
So back to the valuation, that $35 to $65 range.
Yeah, our discounted cash flow model landed there. To get that range, you have to make some key assumptions. Continued strong revenue growth, say 25% annually for the next 5 years, but also that net profit margins eventually stabilize, maybe around 7% long term.
7% net margin isn't exactly tech darling territory, is it?
No, it's more reflective of a specialized hardware provider facing intense competition, and getting even to a stable 7% requires them to reverse the current negative trend.
So the current price, $44.09 in the middle.
Yeah.
It doesn't signal confidence either way.
Not at all. It signals perfect market paralysis, like we said at the start. It's pricing in both the potential for continued explosive growth and the very real risks around competition and profitability.
So the future really hangs in the balance.
Completely. It all comes down to execution. Can they maintain that engineering edge, maybe find the next differentiator? And critically, can they finally start turning that amazing revenue growth into consistent, reliable profit? They failed to do that last year. That's the challenge. Which leaves us with a final thought for you, the listener, to ponder. Given this intense margin pressure, is Supermicro's engineering agility, maybe an advanced liquid cooling or something new, strong enough to create a new moat, one so valuable that giants like Dell actually back off? Or is this market inevitably heading towards a low-margin commodity business where only sheer scale wins?
The crucial question. Okay, that wraps up our deep dive on SMCI. Remember to like and subscribe to Stock Analytics AI. 4.99 members get priority deep dives on tickers. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access. If you want a one-off deep dive, just drop us a super thanks.
And the necessary reminder. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.